Hello, this is Mijanur Rahman from Toronto. I'm the author for the Financial Freedom, a fictional financial plan, and my upcoming book is Financial Freedom, Entrepreneurship. Now, as discussed before, this is the video continuation of video number 7, part 4, after the discussion of the June 7th. The part 4, the continuation from the part 4, video 7, part 4, the continuation that would be part 4b. So this video, in this video series of the Financial Planning Tacit Knowledge series, which is the second series of the second series, and it talks about the financing through equity and debts. Now, today we already talked about the fact checks and safety check to make sure that there are less risk associated with the decision that the company or the managers or the board of the directors or the managements that makes to finance their decision or their projects or their goal or their vision or mission. Now, I have to tell you this. Every company, every management, they owe fiduciary duty to shareholders. And as a result, it is always in the best interest for the management to maximize the value of the shareholders' wealth, or the price for the stock, or the value of the company, if it is not listed as a publicly, or if it is not traded as a public company. Now, there is something that I do wanted to discuss, something that yesterday I think, or actually earlier in the video, I was having this discussion that deals with the financing for the private company under the PE gap. Now, the reason I mention is PE gap is because I would like to keep this discussion towards the accounting perspective, and I know accounting and finance perspective because I know most of the listener of this video series, it is going to be highly, people who would have the industry knowledge, people who would understand the accounting and finance, and most likely a lot of professionals within the industry and the professionals from the other industries as well, like financial advisors, securities advisors, underwriters, accounting firms, accountants, what else? Insurance companies, adjusters, actuarial firms, and so on and so on. Portfolio managers, lot of companies, management for a lot of companies that are actually looking to finance their business in an alternative and other than regular way, or that other than traditional way. Now, this particular video talks about the traditional way of financing, and at some point I will talk about the alternate way of financing that is more beneficial, more effective, maybe more effective to the company depending on the circumstances, depending on the needs, so let's go through this step by step, and then at some point, you'd see that a lot of securities advisors, a lot of actually consultants who works in the capital market, a lot of advisors who works in the capital market, they specialize in a niche market. They have their own expertise. They actually deal with each particular subject area of their expertise. Now, so today, let's start with the traditional way of financing. So I started off with the PE, private entity gap, for the smaller or mid-sized company that want to finance their project through the private through the private method rather than going to a stock exchange, rather than listing their securities on a formal basis or over the counter. But let's find out whether it serves their purpose. So we discussed that the P under the small companies or mid-sized companies who do not want to list their securities and do not pass the SEC's guideline for listing their securities, then they would have probably options of still have the option of raising capitals through sale of shares, through debt financing. They won't be able to issue debt, but they might be able to issue promissory notes, or by working with a law firm, they might be able to raise debts through private contract or private shareholders agreement. Actually, it will be private contract, or through lending from the banking, or the lending through the financial firms, or this will be borrowing from a bank, or borrowing from financial firms. So there is no need for a company who doesn't have to trade on the publicly traded stock exchange, or doesn't have to trade formally on the exchange. Then there is no need for them to incur additional expense producing a statement that complies with the IFRS, so the financial reporting standard. So that doesn't require for them to produce a financial statement, because it could be very stringent, very compliant to the IFRS policies, and it may not require for them to follow that, right? So let's talk about these small companies who might be able to take the benefit of the private entity gap. Doesn't mean that this is less effective. It doesn't mean that their financial statements are not accurate. The financial statements are actually, these gaps were used the same before the IFRS comes in. Under the IFRS, there's a lot of notes disclosure, a lot of disclosures, a lot of transparency. So now under the P gap, with the private entity gap, they might be able to get away with disclosing less information to the readers of the users of the financial statements. But in order for them to actually get financed, they would have to disclose the material items to the lenders, or the lenders of the fund, or where that they're raising the money from. So the question is, they would still have to disclose that, maybe through their legal network, which is through their lawyer, to the lender. So there is the deal is probably privately done. Their information is privately dealt with, and their privacy is maintained in a very often. You'd see a lot of companies that are actually listed. They have the ability to go list on the formal stock exchange to be publicly traded, but they choose not to because they want to retain control. You'd see often a publicly traded company, they actually go delisted on their own, and they restructure their company. So again, there might be different purpose for different reason for making a different decision. Remember, I said you need to gather information. Understanding, analyzing is very important before you make a decision. If any company, any management of a corporation makes a decision, they need to understand why they are making that decision, why they are doing what they are doing. And at the end of the day, the management doesn't work for themselves. They work for enhance the wealth or the value of the corporation, in this case the shareholders who owns those corporations or the corporation they work for. So it is in the management owes fiduciary duty to the shareholders. right? So that's why it is very important for them to understand the fact, the decision they're making, they might be held responsible for the decision they're making. And then because of that, you'll see a lot of sues, a lot of management gets taken to the court by the shareholders and so forth. But anyway, there are another method of financing for a private company, which is the venture capital, right? So they give away the portion of their ownership to the whoever actually finance. Often the venture capital is actually a good way of starting a business. But I personally don't really like the idea of giving away control. They probably want to have the ownership of the company often and a significant level of ownership of the company. And also they would have a lot of conditions in place, but at the same time, they also come with a lot of expertise as well. So they would probably guide you through during the process of transaction, during the, so they'll probably guide you through if the individuals or the corporations actually investing into your business, they would probably have a lot of experience or probably a lot of connections in the market, so they could actually help you marketing your product as well. So it's actually you'd have to make a right decision whether it's good for your business or not. Often I've seen that they probably have a conversion rights, saying that if they're issuing debt, they might have conversion rights to equity, and if they're issuing if they are issuing equity, they might have conversion rights to debt, but those are limited to preferred share, I suppose. Again, I may be incorrect on that, but best of my knowledge, the conversion rights actually comes with the to equity to debt is probably through preferred shares, right? It's already there. Anyway, so so let's move on. So these are the traditional way. Banks, shares, so the lending or borrowing takes place. One of the easiest way for them to finance through banking. If it's a smaller amount, but it's a large amount, then they would have to. That deal has to be probably privately done with. But often a lot of brokers. Broker dealers network might get involved. A lot of investment firms actually, people that deals with actually over the counter, but without mentioning that, they might be able to help you actually help you with this, also with the private financing, right? So that's the another way of actually you can actually finance a small company without going into public. Okay, so the second the another reason that you don't want to give away your control from through venture capital, because because it may not be worthwhile if you could finance your business in an alternative way where you don't have to give away control, right? So again, you'd have to do your homework, see whether it's beneficial for you or not. So let's move on to the company that are willing to go public, that are actually they want to raise capitals, they want to finance their project through very rigid and stringent and compliant policies where there's a lot of transparency. Everything is done through disclosures to the Securities Exchange Commissions. A lot of regulations in place. A lot of due diligence are done, and so those deals are actually done by the underwriter. And so, like I said, so let's say for an example, let's pick a company. In this case, let's pick a company that deals with, let's say, a company was that has a management expertise of 100 years combined, and they came to business 4 or 5 years ago. They've got audited statements. Their revenues are significantly good. They are profitable in a way. They're profitable from the operations. Their earnings per ratios are good. Their balance sheet looks meaningful. Their liabilities are under control. They are solvent. They're liquid, meaning is that they can pay out their obligation as they become due. They meet all those ratios that the SCC or that the regulators look for to for the number crunching purpose. Obviously, every deal actually gets done with very care by understanding the nature of the business. So ratios is actually basically the very first step before they look at the deals. Okay, so make sure that you have the ratios worked out and the ratios passes, and they'll probably look at the deals. So anyway, look at the underwriting the securities, security or the stock that you or the whatever you're trying to finance, right? So now, so a lot of companies often they start offering their stock through the initial public offerings, right? The very first time they go to public, and they actually go through all those rigid process, file those documents with the SCC. Now, in my next video, if I may, it might take me some time, but I would like to show you, walk you through how actually one of those IPOs are underwritten, how the Securities Commission's SCC looks at it, what kind of forms you require, the financial statements, how it looks like, and what kind of opinion the auditors provided. I would like to walk those through, but I think the best idea to actually, I could talk about it a little bit, but I think it's a good idea to place it on the book, on the second book, which is the Financial Freedom Entrepreneurship, so you could actually see. And I'm going to also, I can talk about, pick up, a few of those, maybe quite a few of those stocks that didn't pass, because so we could learn from the mistake the underwriter or the auditors, not the auditors in this case, the auditors or the so like I said, so I'll pick up a few submissions to the SCC that they weren't approved, and I can discuss where they went wrong. Obviously, they would provide them with the reasoning, but sometimes those reasonings may not be the reason, right? So sometimes people, but they don't really come out and say it loudly, what is really lacking. Rather, they follow the guideline rules, right? So say, well, because of this, we weren't able to, because of this rule number, because of this, we weren't able to approve your listing, or approve your filing, or approve the deal, whatever the reason is. And there might be underlying reason behind the reason. So you'll take a look at that. What are the reasons behind the reason that didn't allow them to go public, didn't allow them to pass through the SEC, didn't allow them to get the securities sold full assurance, like the underwriter actually, if the securities are good, the underwriter actually buys them, and